Hello everyone, welcome back to the channel. Today I'll be showing you another video of how to use the Excel sheets that are available on the website. The topic that we will be discussing today is one of the most essential readings in corporate finance section in level 1. It's a very important reading to master, and it's about capital budgeting, basically to understand the different techniques that could be used to analyze the projects and determine if these projects should be accepted or not. So if you go to the website, first of all, to see where the Excel sheet is, you go to Excel sheet level 1, and then you scroll down somewhere around the middle, you will find the capital budgeting file. So the file will be showing you 6 different techniques. You can use the file to solve 6 different techniques. First of all, there's a limitation on the number of cash flows that you can enter. Most of the time, again, because these videos are made for CFA candidates, the Excel files are basically made for CFA candidates. It's hardly that you will find any problem with more than 15 cash flows. That's even an extreme, to be honest. So the file allows you to enter conventional stream cash flows. That's the only way in which the methods actually work. And conventional, as you know, if you do the actual reading, means that the cash flows change signs only once during the lifetime of the project. For a maximum of 15 periods, and then after that it will, based on the information that you enter, it will give you the payback period, discounted payback period, NPV and IRR. It will also show you the NPV profile. That's for the for the first method. In the second sheet, you will see the average accounting return. It is the only method that doesn't use cash flows and actually uses accounting information. Hence the name is average accounting return. So let's go back to the theory from the website. So basically you can find the whole reading on the website if you enter on the link here, or if you go from the help find section, and you will see the different methods that are there. And here we'll just have a quick review for these methods. So payback refers to the number of periods after which the initial investment is covered. Discounted payback does the same thing, except that it takes into account the time value of money. Average accounting return, it's a measure, it's the only measure that uses average accounting, and it measures average net income divided by average book value. NPV is the most used method, and it basically finds the present value of future cash flow of the project cash flows and subtract the initial outlay from it to determine if the project has a positive impact, adding value to the firm or not. Profitability index does the same thing, except that instead of subtracting the outlay, it divides by the outlay. So instead of comparing a positive and negative value, we compare it to a benchmark of 1. IRR is the internal rate of return, which is the rate of return that makes a project present value equal to the present value of the future cash flows equal to the initial investment, which basically makes the NPV of the project equal to 0. I guess the Excel sheet that's available wouldn't show you the profitability index, but it's probably very easy to find it using the information that was given. If you find the NPV, it's very easy to find the profitability index out of it. Now, if you go to the Excel sheet, before I see the problem, make sure first of all you have to enable the content, because there are macros in these sheets. They're not going to work unless you enable the content. So make sure you enable the content, and then let's go to the first sheet. Again, profitability index was by mistake not included in the Excel sheet, but again, it's not that hard to find it once you find the NPV. So let's look at the example that we have over here. It's going to be the same example for all the required data. So given the following cash flows for a project that has 10% discount rate, assuming an acceptable payback and discounted payback period of 2 years, determine if the project is likely to be accepted using each of the methods. So we have the data in front of us, and all what we'll have to do is to do the following. We have 4 years of data, so we enter number of periods of 4. We have a discount rate which is formatted to be in percent, so all what we'll have to do is basically just enter 10%, and then an acceptable payback period of 2. The initial cash flow is a negative 10,000. It's an outflow of 10,000, and then the remaining cash flows goes as 4,500, 4,500, 3,000, and 2,000. And as you see over here, the whole results are gonna appear on the right side. So you have the payback period to be 2.33, the discounted payback to be 2.97. Both of them are gonna, if we use these techniques to analyze the project, both of them are gonna be rejected because we were expecting cash flows to be covered within 2 years, and they took longer. So the criteria is to reject them. However, using the better criteria, which are NPV and IRR, the project is gonna be accepted because it's providing for NPV of 1,429, and its IRR, internal rate of return, is 17.43, which with the explanation for it you can find over here. So it will tell you, because the 17.43 is above the required rate of return of 10%, you will accept it, and the same for the NPV. This is the NPV profile, which shows you what is the NPV of this project if we use different discount rates. It's kind of a sensitivity analysis in a way, that assuming different discount rates, what happens to the NPV of the project. Right now we are done with the first example. If we go to the second one, which uses different information because we cannot use the cash flows to find the average accounting return. So assuming now we would like to find the average accounting return for this project, a company that invests in 400,000 in a project, which is being depreciated using straight line method over 4 years with 0 salvage value. The following table shows revenues and operating expenses. Calculate the average accounting return using 40% tax rate. And we have the schedule of revenue and operating expenses over here. So let's go to the sheet. And again we have 4 periods. We have an initial investment of 4,000,000. Now pay attention over here that this sheet is only assuming a straight line depreciation. If the company, or if the question that you are having is using another method for depreciation, this sheet wouldn't want to work, and you would have to do it basically manually. The salvage value is 0, and the tax rate is 40%. Again, it's entered as discount rate. We haven't been provided any average accounting return in the question, an acceptable accounting rate of return in questions, so we'll just put it for now. Let's assume it's like 20%. So let's enter the schedule of information for the revenues. We have 200,000 for year 1, 250,000 for year 2, 300,000 for year 3, 320,000 for year 4. As for the operating expenses, they were 90,000 in year 1, 100,000 in year 2, 120,000 in year 3, and finally 90,000 in year 4. So we see that the average accounting return that we get was 20.25, which is slightly above the acceptable average accounting rate of return, which means that we will accept the product. This over here shows you the average net income and the average book value, and this shows the decision and the analysis of it. Now, one thing before I conclude is that, especially for this topic, among all the other topics, it's quite important to see that you can use this Excel sheet not only to just create new problems and just to do the math and confirm if you know how to calculate NPV or IRR, but it's quite interesting that this sheet can help you analyze some of the analytical questions. So for example, if you have a question right now that's telling you what are the impacts on NPV of a project if the large cash flows that are received in early periods were received in later periods, so would that increase the NPV, decrease the NPV, or how sensitive is the NPV to the discount rate? When you have a an Excel sheet that can do it to you right away over here. All what you'll have to do is to just put some hypothetical number right away. So you have this project, for example, over here. If you were to analyze the case in which large cash flows were to be received in later periods, we would simply here change the numbers from to basically to remove the large cash flows toward the end and move the small cash flows toward the beginning, and see how that affects the NPV. So if we put 3,000, 2,000, 4,500, 4,500. Now notice that all what we have done is basically rearrange the numbers. I haven't changed the total amount of cash flows yet. You can see that the total NPV of the project has decreased. The IRR, the internal rate of return, has decreased as well. So this is one way. I mean, theoretically, this is because when large cash flows are moved later in time, they have higher effect on the discount rate has a higher effect on them than when they are in early periods, because of the compounding effect, basically. So a question like this, when you have it, all what you have to do is to come up with some numbers, then manipulate these numbers and see the impact of them, and it will help you actually visualize. It will help you understand why things are being done this way. So I guess that's it about this file. If you have any questions, please feel free to email me, and make sure that you subscribe to the channel. Make sure that you follow us on the website in order to get notified every time there is a new post. And again, make sure that you follow us on all our social networks, Facebook, Twitter, Instagram, in order to participate in the CFA Daily Trivia. Thank you all for listening, and goodbye.